unconstitutional. Well, here's the latest banking survey by FICCI and IBA, and it says that the resilience of the Indian economy and the banking sector is likely to continue, but it also warns of looming liquidity concerns. The 22 banks which participated in the survey have highlighted a key issue. They point out that with credit growth outstripping deposit growth, banks are facing pressure to raise deposits while keeping credit costs low. Ritu's here with the other highlights of the report. The chase for deposit growth, that of course continues to be the big concern and the big worry, Ritu. But outside of that, what else does the survey highlight?
Well, there are two prominent takeaways from this bankers survey. Number one, of course, the customer deposits are on a decline, particularly bad among public sector banks, which is causing concerns on the liquidity front. And number two, bad loans, now they are stabilizing, but there are some sectors that are starting to show signs of stress. Now, banks are feeling the pressure to boost deposits while managing credit costs, which is one of the key issues that has been raised by the 22 participating banks that together account for 67% of the industry's assets. Now, there was a notable shift which was seen in the current account, saving account deposits. The majority of the respondents to the survey here reported there was a decrease in the share of CASA deposits, with public sector banks being the hardest hit. Only 24% banks saw an increase in CASA deposits, while 10% reported no change compared to the previous round of survey. On the bad loan front, the findings are a bit more positive. 71% of the respondents reported a decline in NPAs, with public sector banks leading this trend, but there were 10% of banks that said that there was an increase compared to the last round of survey. The textile sector, that emerged as the most affected, with 77% of the bankers identifying it as a key stress area, and other sectors with high NPA levels include infrastructure, food processing and engineering goods. Now, going forward, the banking industry is optimistic about credit growth. Nearly 1/3 of the respondents to this survey, they expect credit growth to be in the range of 14 to 16%, while another 33% anticipate growth between 12 and 14%. Now, that number compares to about 15% kind of growth that the system is currently seeing, so it's more or less on an even stable. Now, on the bad loan front, 52% of the respondents expect the gross NPA ratio to stabilize between 2.5% to 3% in the next 6 months, while 19% predict that it may fall further to 2 to 2.5%. But going ahead, challenges do remain. The survey says sectors like agriculture, textile and particularly MSMEs are expected to see a rise in bad loans in the coming months, and that indicates areas of potential stress for the industry to watch out for.